program. This is a 1 month program we have scheduled from the 7th of April and it is continuing till 29th of April. So far there is no alteration in the timing. So 2 weeks of this program is over. So we have learnt about the Fibonacci principle, we have learnt about 1SD, we have also learnt about that Gann angle and volatility. Then I have taken you to pair trade using beta decoupling. I have also taken you to one standard deviation weekly trade methods. Then we have spent 2 sessions in delta neutral option strategy. Today I am going to take a second session in the pair trade. So whatever the things we have analyzed on the 11th of April, how it has performed till date, that I am going to demonstrate. Along with that, some new info, how we can add some option strategy into our beta decoupling principle, that also I am going to take. And tomorrow I have scheduled for this strategic investment planning and how you can have a trade plan, that also I am going to take, and post which we will be entering to the live sessions. Where in the first live session I will be taking the one standard deviation software and followed with JV software and option strategy, pair trade, all these things I am going to take. So this is what the program schedule is, and this is what you are going to learn in this particular event. So if you have not registered for the last week, you can register in this particular link here, and if you have already registered, no need to register again. Do invite your friends to register and take the benefit of this program. And if you have missed any of this program, then you can just visit to our YouTube channel here, and in our YouTube channel you will find out all recordings. Date wise it is being given, so you can visit those links and get those recordings. As each time in this particular event, in this month's event, I am giving more focus on this one standard deviation, because this is a principle highly getting accepted by the market. Market is obeying this principle very strongly. So that is why I have given more stress on this method. So weekly levels we are giving every week. We are focusing the giving this weekly trend forecast using the one standard deviation, that also we are reflecting in our website, which we have given for the last week. For last week we have given for this coming week, and on 13th April we have released this report. So today's, you can say today's Nifty open happened at 7,900 level. Though it has slipped 7850 level, it has gone, but from there it has bounced. So the closing of Nifty, which was 7918 level, happened and it has gone to 7927 level. So till 0.5 retracement level you have come, and from there it has settled for the day. So we have, as per this particular principle, the uptrend breakout is being given, but first target has not achieved. We have just closed near the 0.5 retracement level. So let me see what happens tomorrow. So based on that, with a clean hedging technique, we will be initiating the trade as I have explained. So pair trade is one of the best method wherein you can able to have a greater control over your trade. So, and same time you will not compromise on the profit. So that is what the benefit of the pair trade. So on this particular pair trade, Smart Finance has done lots of works. So like the beta decoupling method you are seeing, if you are having my book on the futures and options, you will get one more method called index decoupling. You will get another method called sector decoupling. So all these decoupling methods are the pair trade methods. And we also infuse the idea of alpha, idea of Sharpe ratio, idea of Trainer ratio, idea of correlation, All these things also we have added to that pair trade analysis to make it more strong and more realistic and more protective. The very idea is that your position should be more protective. Work and our achievement so far. There is a special session I have kept at the end of this series so that I can share with you what are the innovations we have done so far and what are the expected innovations we may bring for you in the future. So all these things I will be sharing in the last part of the event, last day of the event. So this is about the program, and now move to our today's session wherein I will be discussing the subject of pair trade with option combo strategies, or with option how you can form a successful pair trade strategy. And this is one of the best technique to trade if your idea is to protect your principal to the maximum and get the profit. And it is a mathematically proven technique, and it has the ability to prove time and again, and it has been tested for many years. So it is not the first time I am disclosing this method. So feature of pair trade. So what pair trading analysis we have done on 11th of April. So 11th of April we have 12th of April we have scheduled one event here, and what are the analysis we have done, how far it has worked, that I am going to tell. So till 11th data we have taken, and 12th we have analyzed this particular things and that particular time. So this is the Excel sheet I have shown you. So it was showing that net delta, net beta decoupling was 4.26. So beta decoupling is a very small principle here. So this says that whenever by taking the past 10 days data into reference, we are calculating the beta of a pair. Then we are identifying the decoupling associated with that particular pair. And whenever this decoupling expands and goes to -1 to -2 level, we are entering a trade by the way of buying the dependent. And by the way of buying the independent whenever it is going to +1 to +2. So, and we will be hedging it whenever that decoupling is between +1 and -1. So this is what it says, and every 10 days data we have taken as a small cluster, and in this particular 10 days data what was the beta. So that also I have told you, one formula is there, covariance of x and y divided by variance of x multiplied with 10 divided by 9, or n divided by n minus 1. So by this process I have exhibited that how this decoupling happens and decoupling happens. The day I have taken this particular session, I have told you this is the, as per 11th April data, this is the indication it is showing the net decoupling is 4.26. This suggests that we should buy Bank Nifty, and we should sell SBI. So this is the price reference point is being taken on 11th April. So 12th also no great move happened. So if I can just say 12th what happened. So this is the 12th data if I can take into consideration. So not a great change happened, but this 879 to 937, some couple of points the Bank Nifty has increased, and same time the State Bank of India has reduced by a couple of points. However, that has reduced your that impact has reduced your decoupling to certain extent. 1.29 reduction has come. So if I take that 12th April price point 15,937 and 188.15, as the reference price point, and then after I investigate on the 13th and 14th how it has performed. So if I just take into account these things, 13th there was further reduction, and 18th today that decouplingness of 4.26 which was there when we have conducted this session on 12th, so that time 4.26 of decoupling which was there, now that decoupling has already recoupled, and that decoupling, positive decoupling has come down to a small negative decoupling of 0.4. If this is the case, then how much we have earned from this particular trade, that I am going to tell you. So suppose if I am taking the reference of 12th April price, last traded price, and from there if I am projecting this profit and loss, though this is not the ideal position to book the profit, however this recoupling happened, how much profit it has contributed. If I take, this is the price on 18th April and I have bought at the 12th April price. So this is the price at which Bank Nifty I have bought, multiplied with 30. So hedging component is there, means with that some put option is bought, some call option also is being traded. So that also is there. And now in the State Bank of India case, I have sold at 188.15, and this reference I am taking at 186 point this thing, and I will be multiplying this entire thing with 1000. So this also has given me, so this recouplingness of the beta decoupling which was there has contributed to a profit of 10,240. This is what it has contributed. Take the factor all those losses what it would have taken in the put options and call options if you would have bought it, then some profits also will be left out in this. So this 10,240 rupees profit will not be entirely gone. If one part of this profit is being consumed by those hedging components, still you will be at a profit. However, this is not the proper time to book the profit in this, because you have entered to a beta decoupling 4.26. So you at least wait for the -1 or -2 level so that you can come out from that particular strategy. Then the profitability will be bit higher. So this is what the beta decoupling performed. So this is one of the performance of this beta decoupling. You have seen when the event has happened, and today when you are going to learn one of the advanced form of the same technique. So here, this is what you have learned. Now coming to the next part of this advanced part of this beta decoupling. So the very idea of this particular technique is we must have a great hedging in place so that our principal amount has to be protected to the maximum extent. To the maximum extent we should protect our principal amount. So for that reason only, I have, with this particular beta decoupling, you have to infuse some option strategy. So I have just given you three different idea of this infusing the option strategy. Beta decoupling with 5/2 call and put at volatility turning points. Beta decoupling with net debit bull or bear spread at volatility turning points. This is second one. Third, 5/2 call spread with upper strike put long or vice versa. Ideal condition should be annual volatility between 30 to 50. Or if you are following the Gann's principle, 45-degree trend action must be taken place in the last 2 days. If you are following any of our 1SD principle, then the techniques will be little different. So the most easiest thing to implement this particular strategies with the volatility turning points, or where the trend saturates for that, is with the one standard deviation. So I'll be just telling you one very small, with this same example I'll be just explaining you how you can form an option strategy at that particular turning point. So take this 1SD levels. So 1SD levels of Bank Nifty, it is already in front of you, and this is the 1SD level of the Bank Nifty for this particular week, and this is the 1SD trend level for the State Bank of India. for this particular way. So as per our trade, we are a buyer of Bank Nifty and a seller of the State Bank of India. So this is what we have done. So this is State Bank of India, SBI. I can change it to this thing. So this is SBI. So State Bank of India future and Bank Nifty future. So this reference is being taken with respect to 186.7. So I will be taking with respect to today's price of Bank Nifty 16,230. So 16,230. So now it is slightly negative. It has the chances to go, though this particular trade is in a profit now. So once it goes to, imagine once it goes to the beta decoupling of -2, now it is minus 0.46. So once it goes to -2, then you need to change your calculation in an opposite way, or you have to think that if it goes to negative, I have to buy the State Bank of India and sell the Bank Nifty. Each one lot proportion I am taking. At what price it will enter? So let me take these prices into account. Say this is a negative thing we are getting. So negativeness is there. So I am taking, if both of them are touching the 0.618, means State Bank of India also falling, Bank Nifty also falling. So if I take that prices into account, so if I take that particular prices into account, so what will be the beta decoupling? So I am taking the 1SD 0.618 retracement, 16,009 and 182. 16,009. So I am just changing 182 here and I am taking that 16,009. So this process, it is going to, if this particular price move here, then you are having net decoupling of minus 0.888. So if I can just little expand here, so both of them are correcting, considering both of them are correcting and I am going to a -2 level. So let me focus here 176 and 15,789. So 177 I can say. So if it is, I am saying that 177, and here I am just moving the, before that event happens, I just want to calculate. For that only I am just simulating this one, 15,789. So 15,789. So 789. So that particular case also, if it is Bank Nifty also falling, State Bank of India also falling, in this proportionate way of the one standard deviation calculation what we have done, in this particular way, if they are falling, maintaining both of them are obligating the one standard deviation price calculation, then from 13th April, any price, if Bank Nifty fallen down to 15,789 and simultaneously State Bank of India also fallen down to 177, then I can find out that my net decoupling will be 1.5174. So this thing, suppose if it has happened, I can go for 1.5174. I am going to -1 and -2 level I have entered. Preferably I should enter the trade at -2 level. However, if this particular thing happens, then I will be concluding, if any point during this week, if this particular two price points are touching, then I will be thinking of buying the SBI one lot at 177, and same time I will sell Bank Nifty one lot at 15,789. Any moment during this week, if these two prices are coming, then I will be changing my trade strategy in this way, by the way of purchasing the SBI, which is a dependent, and I'll sell the Bank Nifty at that particular point. So I am taking this one standard deviation price reference points what I have derived here, assuming that this particular price point is happening, and it is, if it happens, and if it both the counters obligate this particular 1SD trend forecast and move in the downward direction and touches that things, then I will be getting this particular levels. So in that situation I can enter. But keep calculating, whenever you are getting at a different price point also you can enter, like State Bank of India fallen, but Bank Nifty is not falling much, whatever we have projected here. In that case also higher beta decoupling you can get, you can enter the trade in this order. So once you are entering this particular trade, I am telling you to create a hedging strategy at volatility turning points. So this is what I am telling here. I am telling that along with this beta decoupling, have a 5 by 2 call spread or put spread at volatility turning points. So assume if this is the truth and it has happened, so what is your volatility turning point? So once you have entered here, so here the Fibonacci plays a very vital role. So once if this particular things comes to true, then what will happen here? Once this price after touching 15,789, if it bounce back and crosses 16,009, which is above the death zone, then you can say that it will be having a volatility turning point and it can move to 16,145. And same time, if the State Bank of India also maintain and crosses 182 level, it has all probability to move to 185 level. And if successfully crosses that 188 level, then it can enter to the upward or the upside trend and it can trigger higher levels. So here I am telling that my volatility turning point as per this 1SD principle, after entering a trade of buying State Bank of India at 177 and selling Bank Nifty at 15,789 will be 16,009 for Bank Nifty, 16,009 for the Bank Nifty, because this is I have sold and it has to be a uptrend, and simultaneously if that is this one is falling, you can say State Bank of India is falling, then I need a second cycle here. So it has to fall below 173.173.62. So it has to fall below 170. So for So this is because one cycle of the State Bank of India is over. Now the second cycle start from the last target of the downtrend, which is 173.62, because I am a buyer in State Bank of India. So volatility turning point in the downside is important for me. So by this process I can say, as per the Fibonacci principle, if it further falls and goes to 171, that which is 170.75, round it to 171, then my downtrend also starts. So this is the worst possibility. Means Bank Nifty I bought, Bank Nifty I sold, it is going up. SBI I bought and it is falling down. So this is the worst possibility. If it happens, then I must have a method to protect my position. So for that reason only I am introspecting on the volatility turning point. So I have concluded in this order. If this is the thing happening for my trade of SBI buy and Bank Nifty sell, then my volatility turning point for State Bank of India is 171, and for 16,000, and for Bank Nifty it is 16,009. So this is what I have got. Now I have to form a 5 by 2 call spread for Bank Nifty, because I sold Bank Nifty. I have to form a 5 by 2 put spread for the State Bank of India. So this trade as it is will be there. So now what I have to do, the once this is 16,009 is crossed over, then 16,145 is there, 16,300 is there. So what I have to do here, little bit proactively I have to involve myself in this particular hedging, and I have to do in this process for Bank Nifty. For Bank Nifty, I'll be selling 16,000 call, 2 lots, and buy 16,145 is there. So 16,200 you can say. 150 we do not have a strike. Go for 16,200. Call option 5 lot. So this is what I have told you to do for the Bank Nifty. What for SBI, what I have to do? I have to sell 171 is there, 170 strike will be there. Put option 2 lots, and once I am selling this 170 put option, then I need to see where the next level is there. So here 0.5 168 it is coming, 165, so 170 I sold, so 1 till 161 my final target is there. Nothing wrong if I can buy selling 170 put option 2 lots and buy 160 put option 5 lots. So this is the protections I have added with the pair trade of buying SBI and selling Bank Nifty. If both the positions goes against me, then when the Bank Nifty comes to 16,200 level, this particular position will be giving me a good profit. I can close this position, and simultaneously if Bank Nifty is also, the SBI is falling and it has fallen down to 161 level, then this position will be giving me the profit. So, but forming this position also involves a lesser cost. That cost part also we have to see. So, if we are going to form this particular position, how much cost is involved? So, I am going to the NSE site. So, I'll just see the cost involved in this particular things, not the margin. So, margin is entirely different. Whenever you do pair trade, your objective is to hedge your position to the maximum. Hence, margin will be different. If you are paying a spread margin, then your margins will be. So 16,000 call option, if I take a reference from here, 366, and 16,200 is 243. So 366 and 243. So 366, I am selling 2 lots. So this is 2 lots, and simultaneously 16,200, 243 I am buying 5 lots. 243 I am buying 5 lots. So cost without the margin part, if I can say, so 243 into 5, this much money I am paying to the market, and 366 into 2, this much money I am receiving from the market. So net I have paid 483 rupees. So 30, if I can multiply, 14,000 I am giving to the market. And same way if I go for the State Bank of India, so this complexity I am adding to my pair trade because I want to hedge it to the maximum, and that too in the volatility turning point or the trend change points. So this is the price points I am getting, and if I am just taking the reference, but that time those options premiums will be different, because whatever reference we are, it means we are taking now with the expectation of 16,200 and odd, but currently we are going to enter whenever the Bank Nifty is falling down to 15,800. So that time these premiums will not be there. These premiums would have been changed by that time, and you will be getting a different premium, and a lesser cost also it will be there. I am projecting here 14,000 based on today's price of 16,200 and odd, but that time that prices will not be there. Once the Bank Nifty fallen down to 15,789, that time prices will be entirely different, and SBI will be 177. That time also 170 put and 160 put will be entirely different. So cost will be entirely different. Just for the assumption sake, I am just telling that if you are entering this 5 by 2 put and 5 by 2 call in this particular strategy at this junction of 15,789 and 177, then this is called the hedging at the volatility turning points. Next point what I am telling here, Beta decoupling with net debit bull spread and bear spread at volatility turning point. So if you do not want to form a 5 by 2 call or put, simply a debit spread or net debit bull spread and bear spread also you can form. If you are forming, if the volatility of those underlying assets are very high, they are in the high volatility band, annual terms, both of them are giving you a volatility band of 30 to 50. That time with 5 by 2, you need to take one more option, the upper strike call option long or put option long, to hedge it furthermore. So when the volatility of this instrument is very high, these two counters what is involved in the pair trade, if their internal volatility is too high, then you have to hedge it something more. So that is also is there. So any kind of option strategy you can form. So or you can make this particular selling of Bank Nifty along with some options as a delta 0 and buying of SBI with some options to make it delta 0. By that process also you can make it. Individual components of Bank Nifty along with some options to Vega 0. Bank Nifty SBI along with some options to Vega 0. That also you can do. Many different processes you can follow to hedge these particular things. And once you hedge it with these particular things, the strikes what you are choosing to hedge the instrument, that must be taken from your trend analysis. That is what is very important. If the price what you are choosing to hedge your position should have or should have been derived from a trend analysis. Either it should be in the 1SD or any of your technical trend, whatever you follow. So if you derive those things with respect to one trend analysis, then the accuracy of this method improves to a great extent. So this is what the beta decoupling along with a option combo strategy you can form for your trading portfolio. Truth for this method. 11th, this event has happened. The recording is available in the YouTube. This is, I am not telling that 11th I have told someone in hidden. I have conducted this event on 11th April where all of you, most of you have witnessed that event. That recording is well available in the YouTube channel. This was the price. If, so sorry, 12th April it has happened. So 12th April if you enter to this trade, then on 18th April what would have happened for this particular trade? What performance it would have given, that I have exhibited here. Once this decoupling goes for recoupling, you made a profit, and the ideal means thing is that if it moved to some -1 level, then you should book a profit and come out. That is what I did. Today it has entered some 0.45 negative, but you are in a profit. If it moves little -1 and all, your profitability will be more. But same time hedging also must, because the correlation is above 0.9. That is also is must. Particular software is a part of our smart IT software. So after loading the data, you can do intraday analysis or positional analysis. Intraday we recommend whatever the yesterday's beta decoupling was there, if that decoupling is expanding zone, it is 10-20% expanded already. So that time we recommend that you should do intraday, so that same day some decoupling can happen and you can make some profit. So this particular things, if you see Bank Nifty and SBI, today it was recoupling stage. The beta decoupling was not expanding, it was contracting. The decoupling was vanishing. So there was no trade recommendation for the day. Bank Nifty axis also was having the same phenomena. No trade recommendation for the day. However, SBI axis has given something by SBI selling axis. But with option hedge, because here too also your correlation is not favorable. Correlation of SBI axis was 0.81, above 0.75. Henceforth, it was not favorable. So all this analysis is being given here in detail, that what is the beta decoupling value is there, net decoupling present in that, what is the beta, what is the alpha, Sharpe ratio, Jensen ratio, Turner ratio, correlation. For every pair it is being given. So whenever you do for a positional analysis, So the things will be different, calculations will be different. So out of this analysis, how many are recommending a buy and how many are recommending a sell, along with correlation what it recommends, that you can get it here. So thing is that once you get these things, if the majority of the things are saying that buying, say today the phenomena has changed and it is saying that buying SBI, selling Bank Nifty, it is recommending, and beta decoupling also is recommending this buying SBI and selling Bank Nifty. So recommended with option hedge also it is telling little bit of more clarity we have added in that programming so that the trade will be more accurate. The concept remains same, little bit of more clarity, more calculations are being added there. So to make it more efficient, nothing else is being added. The concept is same. So beta decoupling is the only one parameter what you have experienced. Same way Jensen's alpha, Sharpe ratio, Trainer ratio, alpha, all these things, spread analysis, all these things are independent studies of pair trade, which is also being added in this particular software. So intraday opportunity, you can find it out. Positional opportunities, mostly it will be there, so you can find it out. One is if you are going for a F&O course with option automated pair trade. So this is if you are going for this particular product, the product number is 9th. So if you are going for this 9th product, so you get only pair trade and option intraday and option positional software along with that, and you get our futures and option course. And if you are going for our smart IT software also, it has that pair trade things, but you won't get any books and literatures to learn the things. So only software you will get in that. So these two products having that pair trade things, and those who are having a full package buyer, those who are buying the entire course at a discounted price of 17,500. So they get all our software including this pair trade 1SD software and everything. So this is our products, and any query on the product you can call in this particular sales number which is reflecting here.